Welcome to the first of 4 short videos in which we're going to explain what we call evidence-based investing. It's an approach that's founded on more than half a century of independent, peer-reviewed research. There are 12 key insights we'd like you to understand. The first 3 insights concern market pricing. Technically, there's more than one market. There are thousands of different markets for different assets all around the world. But for simplicity, let's think of these markets as a single place. Viewed up close, movements in the market seem chaotic, messy, and unpredictable. People used to assume, indeed many still do, that the way to succeed is to outwit other people at forecasting future prices. But we now know the market is subject to a number of important forces, not the least of which is group intelligence. Imagine, for instance, a jar of jelly beans. Ask any 2 people to guess how many beans there are in the jar, and you're likely to get 2 very different answers. But ask, say, 100 people, and take the average of their answers. You'll probably not be very far off. Now apply that to the markets. On average, there are 42 million trades made every day. Any one trade may be spot on or wildly off, but the aggregate average incorporates all known information. The market price is therefore the very latest, best guess estimate of the entire market as to what a particular security is worth. No, it's not perfect, but in all probability, the market does a far better job than you can of forecasting prices. So, what causes prices to go up or down? Essentially, it's new information. For example, reports of a fungal disease attacking Florida trees may cause orange juice futures to soar, as the market predicts that demand will outstrip supply. But for an investor, reacting to news like that is a bad idea. Why's that? Well, first of all, it's not the news itself that's important. It's whether you alone saw it coming. In other words, it's unexpected news that alters future pricing. And by definition, the unexpected is impossible to predict. The second thing to remember is the barn door principle. Markets react to news extremely quickly. Automated traders respond in fractions of milliseconds, so by the time you hear the news, the market has already incorporated it into existing prices, well ahead of your ability to do anything about it. But you might be thinking, what if I can find someone who really is an expert to manage my investments for me and beat the market by picking stocks and timing the market? Well, the bottom line is that all the evidence shows that only a tiny fraction of so-called star fund managers manage to outperform the market with any degree of consistency. In fact, they often fail to survive. One study found that only about half of some 1,500 actively managed mutual funds available in 1998 still existed by the end of 2012. And only 18% had outperformed their benchmarks. Several other studies have produced similar findings. And if you're wondering whether hedge funds are the answer, the evidence shows they're even less likely to survive than mutual funds. So, we've shown you why investment strategies you tend to hear about in the media simply do not work. The good news is that there's a far more sensible way to invest. We'll start to explore it in our second video.